Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Kanish, welcome back to the Australian Finance Podcast.
Owen, thank you for having me back.
This is good fun. We always get to catch up and talk shop, so I'm stoked that we can do it again. In Kate's absence, she'll just have to listen back on replay. But mate, today we're going to be talking about investing in US companies. We're going to be talking about ETFs in general. Obviously, Global X is a long-term sponsor of the Australian Finance Podcast. When we first started, you were there on day one talking to us and supporting the show, so I really appreciate that. But you've told me previously, I can't remember where you told me this. I don't think it was here on the Australian Finance Podcast. You told me that your best ever investment, I think that's how I framed it, your best ever investment was gold. Is that still the case? Can you reveal?
It is still the case. Well, I think I've got a few best investments in terms of not best, but I think a few investments that I keep as my staple or as my core in my portfolio. But gold is one of my best investments. And I say this because it's not the ETF or it's not the exposure, that has returned me the most money. It's not had the best returns relative to, say, I've had investments in, say, ETFs like FANG and things like that, but it's been the ETF that has just consistently provided what it was supposed to do. It did what it said it on the tin, which was portfolio insurance. So when equity markets were volatile, it provided some defense. When interest rates were rising, it provided that defense. When inflation, it's a hedge. So it's actually been a really good ballast in my portfolio. When I look back at my my portfolio for 2022, I'm glad I had gold in there, purely for that defensive alternative. So it's boring, but I actually don't mind that. That's one of my favorite and best investments.
Yeah, great. I like it. You're the only one that's ever said that, I think. So kudos to you.
I'm the outlier.
And Global X obviously being the biggest provider of their gold ETF in the country. So makes sense. My second kind of icebreaker question for you was ETFs are around about $150 billion overall. So there's $150 billion invested into just Australian ASX listed ETFs. I just got that from the latest monthly report. I think it was for the end of July 2023. They're bigger than LICs, like we've taken over listed investment companies, bigger than REITs, the real estate investment trusts, bigger than just about any of those other types of things that you could invest in that aren't shares. Can ETFs get bigger than this?
Well, they're not as big as managed funds. So they're not as big as shares, but they're not as big as managed funds, which is your more traditional investment structure. And so for a lot of investors on this podcast, they may never have invested in a managed fund, or they may not have realized if you've used a financial planner, you then most likely would have had an investment in a managed fund. For a lot of self-directed retail investors to invest in a managed fund, the hurdles are very high, because to access that, you normally have to go through what's called a wrap platform, which again is only for financial planners, so you wouldn't be able to go through there. So you have to go directly to the fund manager, and normally the minimums to invest are $5,000, $10,000, $20,000, $25,000 for the initial investment. So it becomes really hard for a retail self-directed investor to invest in a managed fund. That's actually still the largest investment product outside of shares. So you've got shares, managed funds, and then I would say ETFs. And so there is a lot of room for ETF market to grow, because I think we are catching up slowly, but surely on that managed fund industry.
I think people need to understand this here, that like managed funds are very similar to ETFs. It's really just the way you get into the investment that's so different. And the ETFs have democratized, like you said, normally $25,000 minimums for one of those, or $20,000. When you can just do 500 or 2,000 or 5,000, you can dollar cost average into ETFs. So an amazing thing, and just really opening up what everyone on this podcast can now do with their money. So the third icebreaker I've got for you is something that we've been asked so much on the road recently, which is like how to invest for kids has basically been their question. But my question for you is, if you were buying an investment for your children, or making an investment, you don't have to say how you'd do that, but maybe what are the types of things that you would look to invest in?
It depends on the age of my kids. So
Good answer.
my kids are 6 and 4. Now, I'm probably going to be making some investments on their behalf. I might use a sort of a robo-advisor, for example, to do something like that, to make it nice and simple. Or I might build a very basic ETF portfolio because I don't want to sit there and monitor shares or anything like that. So I may have some core building blocks, whether it be, targeting, the top US companies or an emerging market, having some defensive alternative, a broad fixed income, etc. Some basic, but obviously tilting towards a bit of a higher risk profile for me anyway. That's personally. So again, any information I provide today, it's general. This is specific to my personal circumstances. But if my kids were older, and I think about, I've got a niece, she's 13 years old. She's now at her age where she understands, she's going to Starbucks or she's buying, Adidas or whatever it may be. Mm-hmm. I may talk to her. She wants to look at, she's very environmentally conscious or socially conscious. So I might talk to her and say, okay, if my kids are at that age, what are you interested in? And maybe having some tilts within the portfolio towards things that they're interested in, because if you've got something that they're interested in, companies that they're buying and using every day, then they're more likely to take an interest in their investment portfolio. And then they start to learn. So that's one way as well, I think, for some, for me as a parent, I might start to do that. But right now, as a 4 and a 6-year-old, I can't, my son just wants to buy Lego. So that's one stock, and I'll probably steer clear of that.
So this is such a good answer, man. I really do appreciate this. It's like investing for them at the level that they're at,
yes.
Because that's what you're really trying to get across to them is the education of investing. So get them to buy in and involved in the concept rather than just make it happen for them. That's so important. So great point there. So a lot of this conversation from here on out is going to tilt towards the core of people's portfolios and how to use ETFs to do that. And there are specific ETFs, which we're going to mention in a minute. So be sure to read the product disclosure statement available on the Global X website. There'll be a link in the show notes. But one thing that I've seen, and you mentioned like financial advisors before, I've seen this with financial advisors. It's taken longer, but it's happening. And I've seen this thing happen with individual investors. So many of our community do this. And the thing that they do, Kanish, is they just go all ETFs. They just use ETFs for all of their portfolio. And I'm curious, obviously, as you said, everyone's circumstances are different. But how do you think about that? Like, how do you think about people deciding to do that, whether they're financial advisors or individual investors?
I think it's, how they build a portfolio. It's interesting because I think it comes down to where they are in that risk profile. For a financial planner, they've got certain metrics and rules around what they do to build portfolios. I think in terms of a key part here is what forms a core of a portfolio. If I look at an Australian investor's portfolio, traditionally, it is 98% home bias to Australian equities. And then there's maybe a very small allocation outside, but it predominantly is Australian shares, and then or property. From their investment portfolio. The key part here is ETFs are now, to your point when you talked about it earlier, it's a new vehicle to democratize investing, to provide different exposures and different asset classes, the ability for that in that same investor to now go, I don't need to just have Australian shares as my core. I can have US shares, I can have European, I can have emerging markets potentially as these building blocks, and then I can have some satellite exposure. So you've got this core satellite approach. That's really important to understand. Now, what does that mean? Traditionally, a core has been a market tracker or something that is much more longer term investment horizon. It is your building block. It takes up a majority of your portfolio. Your satellite is where you can provide some extra tilt or to try and potentially look for additional growth, or to try to go and essentially illustrate or to get exposure to a theme or an area that you want to have within your portfolio. So an example there is we take a US equity ETF, and at Global X we just launched a US 100 ETF, and the ticker for that is N100. So that's the tracks an index. It's the Global X US 100 index, which provides exposure to your top 100 companies listed on the NASDAQ exchange, excluding financials and REITs. So these are, very innovative, mega market cap, your modern day infrastructure stocks, your FANGs, etc. So that's a core. But then your satellite is something like a thematic, like electric vehicles, or it could be a satellite like emerging market, like India, or that's where that's satellite. So I think it's important when you're thinking about building a portfolio, you have to have that core satellite approach. I would just put this disclaimer out here: don't just look at equities. At one of your icebreaker questions, what's my favorite ETF still, or the best returning ETF? And that's been gold. I say that because that's an alternative asset. It's not an equity. It's not a fixed income ETF. It's a commodity ETF, a precious metal commodity ETF. It literally gathers dust, doesn't pay any income, but it's doing its job as that alternative. So, we talk about that diversification across equity markets, but it's also diversification across asset classes as well.
So you can have Aussie shares, US shares, or global shares, emerging markets, but then the ETFs have also democratized this, which is then you can have bonds and fixed income.
Yes.
And you can have gold or a commodity, as you said, all in one place, which is very easy to access. And like you said, and I'm actually grateful that you did say, well, it's a good thing that you can do all this, because some people may just end up with just 100% in equities or shares, and that's all they think about, which maybe for some people that's right, but I'd say for the majority of people that's not necessarily the best course of action. We don't know for sure, but that's what I would say. So you did mention an ETF there. The newest ETF at the time of recording from Global X is the N100 ETF. That's the ticker symbol. It's the US 100 ETF. Now, it seems very simple, like the top 100 US shares on the NASDAQ exchange, excluding financials, and what was the other one?
And REITs, so real estate investment trusts, yes.
Okay, so you'd end up with, I guess, like a lot of the names that people will know, maybe, which we can go through in a second. But people will probably be thinking, like they've listened to the podcast, they're familiar with the Global X brand. For a long time, Global X has been known for gold, it's been known for thematics, income. Why did you decide to launch an ETF that, to me, looks and acts and seems like a straight in the middle core ETF? Like it's something that is built for that. Why did you go down that path?
So I think for those that aren't aware, for Global X has been a relatively new entrant into the Australian ETF market as a brand. We acquired a business called ETF Securities in 2022, but Global X globally, around the world, has a very established ETF player. So we manage over $40 billion US across nearly 100 different types of ETFs, and across the world, from the UK, Latin America, Colombia, Brazil, Hong Kong, Japan, US, etc. And what is at the core of a lot of our decisions is research and being innovative and beyond ordinary. So what does that mean? We can say these taglines, we're going to be beyond ordinary. What do we actually mean by that? So one, if we're launching a product or an ETF or an exposure on a particular income solution, a commodity solution, or a thematic, it has to be best of breed. So we're using that research functionality. We've got over 40 people in research. Now, we've launched a core building block though here. But why have we done that? Because here in Australia, we want to provide, again, points of difference for investors. And what we found when we looked at the Australian ETF market, there were products that were offering like exposures to those top 100 companies listed on the NASDAQ, but at a much higher fee than what they should be. So we really wanted to come out, and we've got the scale now. Global X is owned by Mirae, which is a South Korean fund manager. And just off the back of that acquisition, we can offer and we can create and leverage some of those synergies and their scale to come out with lower cost solutions. So it's not always going to be the lowest cost, some of our ETFs, because some of our ETFs are quite unique in terms of how they're built and what they're offering, because they use purity revenue screens and things like that, when we're targeting specific thematics. We've got cryptocurrencies and things like that. But what we're trying to offer here with N100 was a low-cost solution for really investors being able to access just those top 100 companies listed in the United States on the NASDAQ exchange.
It is pretty low cost, if I'm not mistaken. The fee, the management expense ratio, or MER as it's known in the industry,
Yes.
Is about 0.24%. So it's actually really low. We were just talking off air about some of the companies, and I was a bit surprised about some of the companies that are actually inside this ETF, and it's all available. Anyone listening to this, watching this on YouTube, whatever, it's all available on the Global X website. Obviously, ETF provider, so full disclosure there. I was surprised about some of the names because I was like, oh yeah, we could talk about like Microsoft, or we could talk about Apple, we could talk about Amazon, like all of these names that people know and probably the products they use every single day of their lives. But there's so much more outside of those top 5 or 10 that people should be aware of.
Yeah, again, so if we think about what this ETF is doing, so let's break this down. The ETF, it's tracking an index, so that's an equity benchmark. That equity benchmark is that Global X US 100 index. Now, that index gives you exposure to those top 100 companies by market cap or size, so company size, listed on the NASDAQ exchange, and it excludes the financial companies and real estate investments trusts or REITs. Now, when you end up looking at that, you look at the top 10, for example, and we actually saw the top 10 has a lot of those FANG names. So Alphabet, Amazon, Facebook, Tesla, Microsoft, Apple, NVIDIA, which has sort of rocketed up the charts. But it's also got companies in the top 10 like PepsiCo. Now, PepsiCo is doing more than just Pepsi. I'm a Coke person. I love my Coca-Cola. I'm not a Pepsi person. You're either one or the other. But what I would say here is Pepsi's more than just a soft drink company. They do water, they do sports drinks, they do energy drinks, they do a lot more. So they're really entering into a much bigger space. And then you go into the top 20 and Costco. And I think that was one of those companies where you and I were speaking that off air. It was like, okay, well, that is very big in the US, very big in Europe, obviously growing in Australia. And especially with inflation rising and people concerned of cost of living, companies like Costco are really benefiting from that low-cost supermarket or, goods store. But then you go beyond that, you've got companies, an Australian company in there, Atlassian, which, as we all know, it's listed on the NASDAQ exchange, and even Starbucks as well. So it's more than just, I think it's really important. The index that N100 tracks, it's predominantly around 48 to 49% technology. We assume a company like Amazon or a company like Facebook or Meta or Alphabet or Google is a tech stock. Neither of those 3 stocks, by the way, are tech. They are either consumer discretionary or media and communication. So what do I mean by that? Amazon generates most of its revenue from its shopping platform. AWS, its cloud-based solution, is obviously rocketing in terms of its growth, and it's going to become potentially a larger allocation in the from a revenue perspective. If it gets to that point beyond 50%, then maybe Amazon becomes a tech sector company. But right now, it's not. It's consumer discretionary. You look at Alphabet or Facebook or Meta. Those 2 companies are media and communications, and that was a new sector. So we often have to think about this. That used to be technology, but when you have sectors that are constantly innovating, and especially more recent years, innovating at the pace in which they are, these sectors get updated, and they are defined by the company's revenue base. So where is the majority of its revenue coming from, in which particular area? And that's where that company generally sits from a sector perspective. And so when you're having new definitions being applied, and media and communications was that new sector that was defined about 3-4 years ago, because they started to realize that what is a telco company anymore? A telco in a traditional sense was your, putting down power lines and things like that, and the wiring. But actually, a communications company is more than that. It's mobile phones or it's social media. And where they're generating revenue, it's ads. It's
advertising,
social media advertising. So that's how they created this media and communication sector to try and encompass all of those. And then your tech became software, hardware, and semiconductors, very specific. So within technology companies, you've got Microsoft, which is a software company / mainly software, Apple, mainly hardware, NVIDIA, semiconductors. And as I said, so if Amazon's cloud-based solution picks up, it potentially could be a tech company,
Yeah, right.
but it's not. So I often refer to these, the stocks in N100, they're not technology. It could be big tech. I think that's sometimes been a word used because it's beyond technology, or they're modern day infrastructure stocks. These are innovators. And these are really what's driving, when you actually look at, the US market, this is what's really driving, the growth in the US market. It's these types of companies, especially this year.
Yeah, over the last 12 months, it's been incredible. I like to think of them as kind of like the railways of the 21st century, because they're kind of like everything, especially when you think about like those big tech providers and the communications businesses you just mentioned. Basically, everything is built on top of them, right? Like they've developed the railways and we just ride the carriages on top.
Yep.
Some other companies, like an example of a carriage riding on top of this now would be Adobe, which creates the software that's in the N100 ETF.
Yes.
And Netflix, they all ride on top of the internet rails that are basically formed by these other companies.
Yeah, so think of it like this. So you've got a Netflix. It's using cloud, probably from Amazon or Microsoft or Google. You've got then using chips. So then they're having to leverage off an Apple phone, and the Apple phone is using chips that NVIDIA makes or Intel makes or AMD makes. And then you've got VeriSign, which is probably if you need to sign that contract for whatever reason, so all of a sudden, all these companies are working together. And a key part here is they're not just US focused companies. These companies are listed in the US, they're listed on the NASDAQ exchange, but these companies themselves are generating revenues from beyond just the US. And so when you have, say, a weaker US dollar, well, that may not be as a material impact or negative for some of these companies as well.
That's a good point. I do need to go back to Costco, and when I go and purchase my hot dog at the end of my shopping spree, probably spending too much, just wash it down with a hot dog. And I'm buying Costco hot dogs right here in Australia, but it's on the NASDAQ. So
exactly,
maybe not the perfect illustration, but an illustration of how it all comes together. So over on our Australian Investors podcast, it's got to be one of the most popular, or at least most talked about ETFs, is the Global X ETF FANG, which now that the acronym is kind of like blurred a bit, but it's still a super popular ETF. So FANG would traditionally represent Facebook, Amazon, Netflix, Google. They've all changed names, or it's got bigger now. But a lot of people will be looking at that because that's the top 10 US stocks, and as people know them, like the FANG stocks. And then here we've got N100, which is 100, but only from the NASDAQ. People would be thinking, listening to this, they were mindful of things like overlap, or what position in the portfolios do they go? How do you think about that?
So definitely overlap. You can't shy away from that. The FANG ETF is made up of 10 stocks equally weighted every quarter. And it's your FANG M. So Facebook, Amazon, Apple, Netflix, Google, Microsoft, Tesla, NVIDIA, AMD. There's sort of 10 companies, 10% each. So very concentrated. So that's your concentrated growth. So depending upon your risk profile and depending upon where you sit, some, a very risk taking investor may allocate to something as a core. But generally what we do see is that particular ETF being used as that satellite is a complement potentially to a broader US exposure, whether it be something like N100 or an S&P 500 or something like that, because it complements and it adds that additional alpha or additional growth tilt that you're focusing on. Now, when I look at, say, those two particular ETFs to the end of July, say N100's underlying index returned, I think it was around about that 40%, 41% mark. Whereas, and actually I'll bring it up here so that I don't get it wrong.
Yeah, for sure.
So if I'm looking at N100, that returned year to date 44.1% as at the end of July.
Wow.
So I wasn't too far off.
Yeah.
That's good. And then our FANG ETF, because obviously that ETF's actually been live for a little while now. Our FANG ETF there has returned. This is, I'll do the same time period so that you get an indication. So we've got 44.1% for the index at N100 tracks. And year to date, as at the end of July, this ETF has returned 81.6%.
Wow.
Now, that is nearly double. So it's just under double. Now, the reason for that is that concentration. But there is involved in that, there is concentration risk. So you have a broader diversified set of companies within something like N100, which is good. But you have concentration risk when you're looking at FANG, 10 stocks equally weighted. And obviously we've seen NVIDIA and Apple and Microsoft off the back of that artificial intelligence boom really do very well. But in the same way, it is for particular investors and how you allocate it to it. It's either for some of those very high risk investors, it potentially could fit as a core. But I think for a majority of investors, it becomes that satellite to complement a broad core solution to really provide that additional growth.
That makes a lot of sense because and we've been chatting about this on the roadshow with the Global X team, that a lot of people do use FANG as kind of like a concentrated, like put the microscope on those really big, like competitively advantaged technology companies, quote unquote technology companies. But something like that they would be missing is obviously things like Costco or Pepsi, which we just brought into the conversation. How about then, because you did mention it briefly, is like the S&P 500 is the thing that a lot of people, maybe they see the Dow Jones more on the news, but they also see the S&P 500, which is, again, one of the most popular overseas investments for Aussie investors. They see, well, the top 500 US companies, it's really, it's 500 seems really diversified, etc. How would you juxtapose or compare N100 to the S&P 500 portfolio or companies?
Yep. So I think a key part there would be what is, some of the differences. So what we actually see, we'd say something like the S&P 500, the index itself is only say 27 or 28% tech related. Now, why is that? Well, we look at it from this perspective. The N100 ETF is looking just at companies listed on the NASDAQ exchange via tracking that Global X US 100 index. So it's looking at companies listed on the NASDAQ exchange, which means it's generally the NASDAQ exchange. What do I mean by listed? So, here in Australia, we have the ASX, and that's been the primary exchange that we have. We've got CBOE, which has started to come together, come on the market recently as an alternative exchange, but still it's sort of moving forward in terms of having companies listed on there. So you only had one. In the US, you've got multiple exchanges. You've got CME, the Chicago Mercantile Exchange. You've got the New York Stock Exchange. You've got the NASDAQ Exchange, which was sort of founded about 30 to 40 years ago. And it became this hub or this main source for tech companies and companies that really wanted to be very innovative and at that forefront of innovation and technology. So that's why we see this 50% tech sector exposure. Whereas the New York Stock Exchange is a more traditional exchange. So you've got companies like Berkshire Hathaway, does not list on the NASDAQ exchange, so won't feature in N100, but it's listed on the New York Stock Exchange. So it's going to be in indexes like the S&P 500, because the S&P 500 index goes beyond just the New York Stock Exchange. It goes to every individual US or some key US exchanges. So I think that's a really important point. The S&P 500 index goes quite a broad view of the total US, whereas ETFs like N100 or its peers looks at just companies listed on the NASDAQ exchange, which means it's tilted towards more innovation, more technology. Now, I would argue some of these companies are modern day infrastructure stocks. To your point, they're now sort of the railways, the railway companies of the future. But in how historically that has worked is they were more sort of different types of exchanges. So you do have differences. The other key difference there is 100 versus 500. You are generally going to have a more concentrated, in the same way we see FANG. Your FANGs are ultra concentrated, very growth orientated. NASDAQ 100 or index or the N100 ETF, for example, is very much focused on this broader innovation set of companies. And then the S&P 500 index, for example, is beyond that. So it's got companies like energy, financials, it's got consumer staples, etc.
Yeah, you'll get those banks and those types of businesses in there. I remember looking at the list and comparing the N100 versus the S&P 500, and one of the big outliers for me was just basically Berkshire Hathaway, but that's only like one of the names. And obviously for folks that don't know, Berkshire Hathaway is the company that Warren Buffett runs.
Yes.
And so that was probably the one that stood out for me. But other than that, like if you believe in like the technology kind of thematic overall in the next 20 or 30 years, it's easy to see why people turn to NASDAQ listed companies, because they are like the Apples of the world, that are redefining kind of the game for the next generation, the current generations. So obviously people can find out more information on the Global X website, and there'll be a link in the show notes. You can click the link. It even takes you to a map of the Australian marketplace for ETFs, where you can see all ETFs listed there, and you can find out all the information. The table on the Global X website has all of the individual holdings if you want to check them out and view performance. And good on you, Kanish, for checking the performance. I did actually check it after you said it, and I was still equally blown away. I didn't realize the performance was that I guess impressive for FANG. That took me by surprise. So it goes to show, if you do have a concentrated portfolio and you do get that right, what can happen, right? But I've got one final question for you, and this is a really hard one. So I'm going to see how you go with this one. I haven't fully formed a good answer to it myself.
Here we go. Okay,
here we go. So the hard question that I have is, you've been doing this a long time, right? What's one thing that you believe about finance? It could be investing, it could be business, but what finance, business, investing, that few people would agree with you on?
Gold.
Okay.
No, I think that is a tough one.
Gold could be your answer. That's actually seems like an instinctive response.
Yeah, I say gold because it's so divisive in Australia.
It is,
because we are so attuned to buying mining companies, and therefore, if I talk about a commodity, it has to be a mining stock. And I'm just sometimes, talking, and I'm just not saying with a self-directed retail investor. I'm saying with institutional investors. I'm talking, super funds, private banks, sophisticated wealth managers. We are having this discussion day in, day out across my team with these types of clients and these types of investors, because we're talking to them and saying, you need to understand that gold has a place in that portfolio, but it can be so polarizing. And they're saying, no, it doesn't pay an income. I've got Newcrest. I'm good. It's like, no, wait. Let's take a step back. Newcrest has a place in the portfolio, but your gold has a place in that portfolio. So I think I'm hoping that as time goes on, and I think it's already started to shift, but that doesn't actually become an answer that people disagree with, or an opinion that people disagree with, and it's an answer that people actually fundamentally wholly agree with the fact that gold does have a place, because we see it overseas, just not necessarily here in Australia. So I'd say actually that, and the other one I would say is, property is not the be all and end all. I'm obviously, I'm probably maybe slightly biased, being part of the investment industry, being part of an ETF provider, but I don't think property necessarily has a place for certain people, and obviously it's become harder and harder. So I think that's been one that I've started to feel Australians started to look beyond just property as an investment. Yeah.
Well, you definitely picked two divisive ones, mate. So that's good. That's what this question is designed to get out. And
I say that as a property owner as well, which is really hard. So I should listen to myself, maybe.
But no, that's great. So we've talked a lot about the US market and how to get involved. Obviously, the launch of N100 is really exciting for Global X. So I wish you all the best with that, mate. And good. I love to see this type of ETF available for our community. So thanks for taking this call on short notice and jumping on the podcast and talking with me, mate.
Thank you, Owen, for having me.
Cheers.